All right, now let's dip into your pro picks, your highest conviction ideas in the market. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, before we get to your top ideas, I want to revisit some of the ones that you brought to us in March. You were on March 27th, and your first one was Source Energy, which was interesting because we talked about how you're not a commodity investor, but this is adjacent. It's been a bit of a wild ride. It's up 2% from March 27th, but it had a nice run after you picked it up, and now it's back down, kind of on poor results. Mm-hmm. Their recent results were not great. Talk to me about whether you've owned it through this period. Do you still like it?
Sure. So we've owned the stock since about $1.60. That would have been in 2021, 2022. I don't remember off the top of my head. So we've had a great return on the stock. But going back to your point earlier, these stocks can fluctuate quite a bit, given that they're small caps. And this is one that is, even though it's not a resource stock, it's energy services. It's tangential to oil and gas. So the volatility is even higher here. Plus, in this case, it's a pretty thinly traded stock. There's a couple large shareholders, including myself, and it's a relatively small company. So trading can be liquidity driven as well. You get a big buyer or a big seller in the market that can push the stock up or down 10 or 15%. In terms of the quarter, what the company cited was a very busy energy market in July and August, and then a very, very slow market in September. So when I spoke to them over the summer, I got the sense that the quarter was going very well, and other energy services companies that I talked to were saying it was extremely busy over the summer. But in September, I think you had a bit of budget exhaustion from the bigger E&Ps, and that affected their results. That being said, the company did a good job talking about the rest of the year, so Q4 and then moving into next year. And the elephant in the room here is LNG Canada, which, if viewers are familiar with, is a massive project. It's going to have a huge effect on the demand for sand. And one of the reasons I like Source so much is this is a highly strategic asset. There's only a couple sand players in Canada. If somebody wanted to duplicate this, it would be very, very difficult to do. You'd need hundreds of millions of dollars, a lot of time. Source is really, even though it's a sand business, it's really a logistics business. It's how do we get this sand from Wisconsin, which is where they bring it from, up into Canada and then out to the projects where the companies and the customers actually need it. So the quarter was a little soft. I think Q4 will be good. I think Q1 will be very good. And as we get into next year, I think it'll be very strong. This company, I think, is also a takeout candidate.
SHLE is the ticker in the Canadian market. So you owned it at $1.22. It's $10.64 today. So on a pull, it sounds like you're not fussed on the pullback.
Yeah, this is one where I actually, the company did a good job sort of talking before the quarter about their results maybe being a bit weaker into year end. So we did trim some going into the quarter up higher, maybe around 13, 14, and then looking to rehook it. I thought it would actually maybe hit 10 if the quarter was really bad, given market conditions. I think it hit 10.50. But happy to buy that stock back.
What about Mainstreet Equity, a stock that you loved? It hasn't really done much this year. We did get actually a few questions on it. Mm-hmm. And it's down about 2% since you chose it, but there were some peaks and valleys in there over the long term. And we've interviewed Bob Dylan, and I know you know him well. It's an amazing story, but this year it just hasn't been.
Yeah, listen, I wish, you look at this stock, it's compounded at about 18% over 20 years is the math. I wish it was 18% a year. I wish it was like a machine where you just put in a coin and you get your 18% every year and that's it. Unfortunately, that's not the case. Unfortunately, we're going to have years where the stock's up 40% and we're going to have years where the stock is, I think this year's down 8 or 10% or something like that. Nothing at all changed in the business other than the fact that maybe a change in immigration policy has affected demand slightly, but the demand for the housing that Mainstreet has so far outstrips the supply that it's not a concern. The stock's trading right now about 24% discount to my calculation of net asset value. We've seen the stock trade at a premium in the past to net asset value. So for new investors who are looking at it, I think it could be a great time. And for investors who already hold it, I'm very happy betting on Mainstreet long term. And I've said before, out of all the names in my portfolio, this is the one I worry about the least. Highly defensive business, extremely well run, fantastic CEO. I think you're going to see that continued 15, 20% compounding year after year after year or more.
Well, I know we'll see that clip somewhere. Bob will post it.
Bob is so good. By the time I get back to my office, I think he will have sent it out to me.
He will have emailed you about it. Okay, your third, so we're flat on the other names, but they were made just a couple of months ago and you're still holding. And we know you're still holding Propel. Yes, everybody, we're finally bringing up Propel. I saved it till now because it is both a past idea and you're still sticking with it. It is one of your pro picks today. It's down about 10%. Again, volatility in there. One of those lenders to people who don't have access to credit. So kind of in the same lane as Go Easy. And unsurprisingly, it has also kind of struggled.
Mm-hmm. So let's talk about why it struggled. And then let's talk about what's actually happening at the business. Why has it struggled? So some of the reasons are the same as Go Easy. Some of it is macro. So it's in a sector that people don't particularly like. The Go Easy short report actually didn't help Propel. Propel was down over that number of days because people start making inferences. Oh, well, if there's a problem at Go Easy, maybe there's a problem at Propel. What people don't understand is that aside from them both being Canadian listed non-prime lenders, they're very, very different companies. Go Easy has physical branches. Propel does not. Go Easy operates exclusively in Canada. Propel is primarily in the US, a little bit in Canada, and then growing in the UK. Propel is all online. Propel is all unsecured. Go Easy is half secured. There's so many differences between these businesses that, while you can compare them because there's not a lot of good comps for them in Canada, they're very, very different businesses. So I think it's been hurt by the Go Easy short report, the general weakness in Canadian small cap growth. And then on their most recent quarter, they actually brought down their guidance for Q4, which investors didn't like. But let's talk about that for a second. So they brought their guidance down for their loan book growth from 25% to 18 to 22%, which the reason they did that is they noticed the consumer was having a little bit of trouble in the US. So they tightened up their underwriting. So they essentially hived off the bottom 10% of the loans that they would normally approve. And they said, we'd normally approve these loans. We're not going to do that anymore. We're tightening our underwriting. When you do that, your growth will slow a little bit. But I guess my point is most companies would kill to have 20% growth. And here's a company that's being punished for having 20% growth. And you're punishing the management team for being a little more cautious when in my mind, that's actually the prudent thing to do. So when you look at the growth rate, it's still extremely impressive. I was chatting with the CFO recently. He talked about being highly confident that the company can grow at 30% a year for the next 5 years. So, and they've been growing faster than that. Their top line's been growing way faster and their bottom line has been growing extremely quickly as well. This company has a lot of runway in the US. They do have some runway in Canada, although I get the sense it's not a huge priority for them. And then the UK is going to be an absolute home run. They bought a small platform business in the UK. It's growing like crazy.
Is it also possible, like it came to market in 2021 when the vibes were great, and as you pointed out, look at consumer stocks in the US. It's clear that there is struggle out there. So it makes sense that Propel would be vulnerable. And maybe is it just the fact that you haven't seen a long history of this company, so you don't know how they manage those cycles?
No, because the company actually has a 14-year history. So even though they've only been public for 4 years, they have a very long history. They've done billions of dollars of loans, millions of customers. A lot of companies might say they have very good tech, like Propel says as well. But I think the really important thing with some of these online lenders is the data, which Propel actually has. So I think we do know how they perform. What I think investors need to know is when they slow growth, they're doing that to preserve profitability. So the way that management is looking at the business is, what do we need to do to our underwriting to make sure that we preserve our margins and our profits, which is what they're doing right now. So it's a bit backwards, but the way to understand these businesses is when they grow faster, they look less profitable. And when they grow slower, they look more profitable. And it's kind of backwards because when they take on new loans, they have to take on provisions associated with those loans. So the more new loans, the more provisions, the less profits, and vice versa. So what you could see, and we did see this during COVID with some of the lenders, is when they slowed down their originations, their profitability went way up and they look cheaper. That being said, this is, I've said before, one of the best growth stories in Canada. I mean, I talked recently about the company with someone and I said, even if you just look at something as simple as top line, for example, when they went public in 2021, they were doing about $120 million of revenue. This year, they'll do $600 million. So sales have gone up 6x in 6 years. Again, not too many companies that I know of that can show me that. And now the stock's trading at 6 times earnings with a 4% dividend yield. So you've got growth if you're a growth investor. You've got valuation if you're a value investor. You've got dividend yield, plus management and insiders own close to half the company. So you talk about alignment. So when you look at my checklist, so to speak, of things that I like in a stock, this one's got it all. Yet the market's giving it no love. And I think that's going to change. We saw that last time the stock went down to 6 after the IPO, and then it went from 6 to 40. So I think, and I've said this before publicly, I'll say it again, I think this is a $100 stock within 4 or 5 years. And it's a $20 stock today.
From your lips. Let's see.
Well, we have it recorded. So
let's
see what happens.
You are on the record and you come back in good and bad markets.
Yep.
So I do appreciate that. We talked about Constellation and how you bought it for the first time in 6 years and you don't even buy large caps. Let's talk about baby Constellation, which is Lumine, spun out of Constellation. And in the span of less than 2 months, it has dropped 60%, almost 60%. What has gone on?
Yeah, I mean, I wish I could tell you definitively that I know exactly why the stock's down this much. I am scratching my head a bit over it. I mean, you would think that it could decline in sympathy with Constellation. That makes sense. You would think maybe that investors have the same concerns. Lumine's a bit of a different business than Constellation. So maybe I'll just talk about that for a minute for those who don't know the differences. Lumine was the media and communications group of Constellation before the spinoff. And then it got spun off. And they generally do way larger deals than Constellation. So they'll go to a company like Nokia, for example, and Nokia might have a division that they don't want anymore, or that a previous CEO started, or a business they don't want to be in anymore. But when Nokia sells that business, those customers might be customers of Nokia in other businesses. So they have to be very careful who they sell that business to. And Lumine has become a trusted partner for some of those big telecom companies in terms of these carve-outs, they call them. So aside from the Constellation issues, I think one of the things that's hampered Lumine is they haven't announced a big deal in a while. And typically the way these stocks look is they announce a big deal and investors get all excited and they recalibrate their numbers and they come in and buy the stock. And then it kind of goes quiet again until we see earnings or M&A. So outside of the general Constellation issues, which we talked about at length, and lack of large M&A, I can't really tell you why the stock is down so much, but I can tell you it's a very high quality compounder. It's Constellation type DNA, Constellation type financial metrics, again, trading at, 20 times earnings.
And so it's your top idea. Where do you think it goes from here?
I think you're going to make 20 to 30% a year on this stock for this foreseeable future.
Good. I own that one too.
Okay, good.
And I'm down. Not been a good year for my quality picks.
Quality is out of style. That's what I said earlier.
Talk to me about this one, your third pick, an Israeli company, ZOMD, and it's small. It's a little teeny tiny thing. Why do you like it?
Well, as you know, we're not afraid of small. And I think one of the things that I like to do is try to find these really high quality growth stocks early before other investors are onto them, because that's when you can really do very well in the market. You find these companies that are great businesses that nobody knows about. They're trading at these low multiples. And then over time, as they work through the, call it Mainstreet ecosystem in terms of, going out and seeing the brokers and then starting to do presentations and eventually getting some analyst coverage, which we just saw with this company. ATB Financial picked it up about a month ago. Mm-hmm. So it's just starting to get out there, but most investors probably haven't heard of it. Israeli ad tech business. And I followed it for a couple of years before I bought it. I met them at a few small cap conferences and I was really intrigued, but they had some trouble in the business that they were cleaning up. And they cleaned it up a couple of years ago. And then the revenue and the profits just started to take off. I didn't buy the stock right away. I started looking at it around 60 cents. I managed to get, and it was also a liquidity because it's pretty well held by insiders. So I managed to buy a block of stock several months ago, and then the stock almost doubled right away. I know, yeah. Which I think
good for you.
I bought it at $1.17 or 18, and then we went almost double right away. They went out to a couple conferences. They put out a couple quarters. This company has really blue chip clients, and when I say blue chip, I mean I'm talking Amazon, Nike, Shein. Am I saying it right, Liam? Shein or Shein? I don't know.
The NBA.
Okay. Anyway.
The NBA, McDonald's.
So those are the types of customers they have. And what they've really done with these customers has been a land and expand type of model. So Amazon might come to them and say, hey, we want to try out your technology. we'll let you start in the US. And then if you do well, we're going to give you the UK and we're going to give you this country. So that's what's been happening is they've been landing these Fortune 500 brands and then expanding with those brands. And I can't tell you that I'm an expert on ad tech or technology per se. Again, it's one of those sectors where everyone's going to say they have the best technology. The proof to me is in the customer base that they've been able to attract. Let's face it, these customers can use whoever they want. And they're using this small little company for their ad tech. It's actually really interesting. And then the second piece is if you just look at the growth and the financials, the company's growing very quickly. Their margins are very high. This would be a bigger position for me, but they don't have a ton of history, number one. Number two, ad tech can be highly cyclical as the economy is growing, expanding. And number three, the company doesn't, although they talk to the street, there's no guidance. Up until a month ago, there was no analyst coverage. So I had my own numbers, and those numbers were, educated guesses, so to speak. So I really like the business. I really like the financials. I really like the growth. So it's a starter position right now, but I like to come on the podcast and give viewers maybe an early look at some of the stuff we're working on in companies that they're probably going to hear more about in 2-3 years mainstream that they're just not hearing about now.
The ticker is ZOMD on the venture. And yeah, the revenue, it's about to hit 100 million. A couple of years ago, it was below 70 million. But again, I feel like it's worth saying, you have said it, but such a small cap. Let me look up the market cap, 170 million. So not as teeny tiny as NTG, for example. But you have to be prepared for a 20%, 30% sell-off.
Yeah, and sometimes the best way to deal with that is position size. And what I mean by that is if you're going to own some of these smaller racy names, you can take a bit of a basket approach and say, I'm going to buy 3 or 5 of these names in small proportions and 1 or 2 of them might work and I'll add to those over time. But I think with small cap in general, that's something that investors really need to think about. I mean, I've got a almost full allocation to small cap because that's what I do. But for most investors, they want the returns of the small cap market, but they don't want to suffer the volatility. And the way to do that is by sizing your positions properly. So in your portfolio, you may want a 10 or 15% weighting to small cap. And if you get a year where you're up 30 or 40 or 50%, that's really going to help your returns. And if you get a year where you're down 20 or 30%, it's not going to kill you if it's only 10% of your portfolio. So I think sizing is the way that investors can get comfortable if they're not comfortable with this volatility.